Hey everyone, welcome to this edition of Navigating the Markets with me, Markets and Mayhem, coming to you Sunday, May 19th. Last week was pretty crazy, and the week ahead could be even more interesting as we're now unclenched from gamma exposure, that 5,300 level on SPX really becoming the center of gravity for this market. But as we get into next week, we're more free to move about the cabin, as it were. So let's take a look at some of the things I have on my radar. First is headline and core inflation. We got CPI last week. It didn't really give us a sense that the worst is behind us. While we did see some moderation in services and in core, at the end of the day, it's still a sticky situation. Inflation remains persistent. A lot of this has to do with this late cycle fiscal stimulus. It's amazing to me, quite frankly, that so many Fed speakers are not being forthright about this. Barkin last week blamed the consumer, saying the consumer is willing to take on higher prices. It's not really true, especially when you look at the bottom two quartiles of consumers that are downgrading to white label or generic brands wherever they can to save money, that are putting more and more on credit cards where they're facing record balances and record interest payments. These are consumers that just registered some of the worst consumer sentiment readings that we've seen from University of Michigan in quite a long time. One of their big concerns, you guessed it, inflation. So to say that consumers are willing to accept higher prices and that's where inflation's coming from is at best disingenuous. The reality is that this late cycle fiscal spend has helped to push demand into an economy that was already a bit supply constrained. And that's why inflation's resilient. And that's one of the reasons it's likely to stay that way unless the government takes its foot off the gas. Another chart that gives us a sense of what's really going on with inflation and takes some of the wind out of the sails of the idea that people are just willing to pay more for whatever they're buying. If that was the case, then we would see real retail sales increasing and not flatlining. The fact that they're flatlining and actually even coming down a bit tells us in a very simple picture that's adjusted for inflation that consumers are spending more to get the same or less. They're not readily gobbling up higher prices. They're actually struggling to maintain their budgets. And so I think that we need to add a little bit of nuance, some context to the analysis here. Again, it's all fiscal. And look, I'm not alone in this point of view. When you look at seasonality of government spending, last year and this year, that's the third and fourth year of a presidential election cycle, tend to have pretty robust fiscal spend, particularly the last year, right? That's where we are now. This is data from Bank of America going back to 1959. I think that gives us a pretty good sense that we're likely to still see that fiscal excess. Is that going to be the right call? Are American families going to want to have elevated inflation, or would they have preferred a moderate recession and some reset in prices? I personally think they would have preferred the moderate recession, but we are where we are, and we'll get to realize whatever those political consequences are come November. Now, if you're going out there and surveying fund managers, they have a pretty similar point of view. That is to say, fiscal policy globally is too stimulative. This is one of the things that's adding to that inflation tail risk. It's continuing to keep in global inflation levels elevated. As we can see on this chart, most economies are going to stay above 2% year over year inflation this year. So one of the things that we've talked about at Traderade for a while has been long utilities, long industrials. And we can see that these are two areas that have really performed. Long industrial has been something I've been adamant about since the beginning of this year. Utilities I got adamant about really over the last month and maybe a couple weeks ahead of that, right? So this is an area where we've seen incredible performance. Utilities now year to date running neck and neck with tech as a sector. Who would have thought? One of the most boring parts of the market. Well, we thought because A, there's some demand for more defensive allocation, but B, there's a real long-term story here with utilities set to see increased revenue and increased earnings as they expand generative and transmissive capacity to account for a near doubling in U.S. power demand over the next 10 years. So we've liked XLU, we've liked Dominion or D. We continue to like these names, and we continue to believe there's more opportunities in that space. It's also one of the reasons I've been adamantly long energy since late last year, and talking about one energy name after another, really ahead of everyone out there on this turnaround. And in fact, I'll show a little bit later in the presentation. I don't often pat myself on the back, but I do want to show some things we've been very early and right about, just to give a sense of why we do what we do at Traderade and how a systematic approach where momentum and macro combined can give you some really good setups. Next up, though, let's talk about JP Morgan's tactical positioning indicator. It is on the rise, but it still has room to grow. We are not at a point where you could say short-term tactical positioning is very stretched. Now, that does run a little bit into what we see with retail sentiment and active money. So if we look at AA, we see retail sentiment shows an excess of 76% of bulls versus bears looking 6 months ahead. People got really bearish earlier this year, right? That's more, actually, I'm sorry, they really got really bearish late last year. Then they got really bullish going into December, and we've never really seen a reset. Now, that doesn't mean one has to happen. In bull markets, you can have extended long, positive sentiment for some time. But that doesn't necessarily tell me anything that makes me want to get really, really aggressively long either. That is to say, we never saw that flush out, right? So we're still in a market where there is some degree of complacency. You can see it in the lack of hedging. You can see it in some of the positioning measures we've talked about. These are things that we talked about last midweek update. I've talked about it on navigating the markets. Those things have relatively stayed the same. Like if we look at NAAIM positioning, you can see that last week it ticked down just a tiny bit, but it's still very elevated here. So again, there are longer term positioning and longer term sentiment indicators that are still very elevated. The short term tactical tells us we might have a little more room to run. When we look at the number of NYSE stocks above their 20-day moving average, this is getting pretty extended. It's even more so than we talked about it on the midweek update. So I thought I'd give an update here. This is at a point where I'd be more concerned that left tail risks are fattening. And that's over the intermediate term. We've gotten very stretched. And so often is the case, you're either going to have a correction in time or price, or both, right? A correction in time just means a consolidation. A correction in price means a drawdown, and both would be a period of consolidation that's a bit choppier, a larger range with some room to the downside. That's what I'm looking for just as a baseline. I think we do have some room to pause, to cool off. I think it would be healthy. I think anyone who's truly been an investor or a trader for a long time would want to see a little bit of a pause and a cooling off if this rally is going to continue. Now, here's some ideas, and then we'll get to the back padding. Take Two Interactive. I like this one. I just want to see it closing above the cloud here. I mean, basically, if we can get a close above 152.14, I think the next upside target's going to be around 161.14 and then 166.65. Those are two areas I'd really be looking for. I know this isn't a huge upside opportunity, but it's just about 9%. Played with options, I'd be looking at a July vertical spread, buying the 166 and selling the 167 calls. I think that would give us an opportunity to potentially look at this from a more conservative point of view. That is to say, we sell those 167s to reduce the cost of buying the 166s. That's what I'm considering. It's obviously not financial advice. You have to make sure this comports with your trading strategy and your risk management approach to see if it's the right idea for you. But that's what I'm looking for Take Two. And I have a similar idea for SBCF. This is a regional bank. It is breaking out of a downward wedge. I like how it's above the cloud and above the point of control. So for this one, I'd actually be looking for the 27s in July, running this as a vertical call spread, buying the 27, selling the 28 for SBCF. For both of these positions, I would be managing risk. Just looking at Take Two, I'd be managing risk on this one using the 50-day moving average. It's not on the chart, but you can plot it on your chart. And for SBCF, I'd be managing risk using the point of control, which is just about $24. Okay, so these are opportunities that I like on a swing time frame, about a 2-month time frame. And the reason I like them is there's an improvement in technicals, and I think that there's some opportunity for momentum to continue moving higher as we reverse. Now let's talk about oil. Oil, I think, is bottoming. Now, I've said that I need to see a move above 81.50 to really get my conviction higher, and I'm still of that point of view, but I don't mind nibbling here, starting to build a swing position in CL, taking about a quarter of that position on in crude oil futures, and then if we're able to break above 80.56, putting another quarter on, and if we're able to break above 81.50, putting that last half on. And I'd be targeting 83.71 for the core, and 86.38 for the runners. I'd be managing my risk on this one by, as we get above each one of these levels, moving my stop higher. The next one I have here is Henry Hub Natural Gas Futures. This is a little bit of back padding. I said on April 3rd, I was starting to get bullish. Seasonality was starting to become more preferable. I felt like the natural crash had sort of run its course. And while we're still above the 5-year max storage range pretty significantly, I started to get more constructive on natural gas just because we know markets look forward. And we know that it's likely to be a hot summer. And that there's other various areas. It could be a pretty nasty storm season. And so overall, I just started to feel like natural gas demand is going to come back. That reshoring of manufacturing, another area that brings it back into the foray. You know, the increase of power grid demand as time goes on. A lot of things were kind of telling me it was time to start looking at natural gas more constructively. So I put that tweet out there. I also talked about it on the Traderade Discord, on some of my live streams, and in the commodities room, just saying, you know, I think it's time to look at natural gas more seriously. I've liked FANG or Diamondback, but we can see the commodity has agreed with that call, rallying significantly, up about 50%. Some of that is the rolling of contracts, but this has still been a pretty nice trade opportunity. Now, I always recommend caution trading something like this, so it'd be a very small position. Nevertheless, almost 50% on a small position is good anyway, over the course of, well, it's about a month and a half. The next one we have is silver. Silver, I've been adamantly bullish on. I actually started talking about this breakout way earlier, so I was bullish on it in March. We know that. We've been talking about the breakout that happened, but I also got constructive on it during the last pullback. And I said, I still think we're part of a longer term bull market. And the reason I said that is a lot of people were saying it's over. Precious metals are going to crash. There's no reason for them to run. And if you remember, I've been super skeptical of the prior silver rallies going all the way back to 2020. I was like, you know, they're going to chop in a range. We could get up to 30. But this time is different for me. We're finally breaking out in a big way. And the last time silver traded like this, it ran another $20. And I don't think that's terribly unlikely this time. I think we have the animal spirits back in play. Investors are back in the precious metal space. Industrial demand is back. That's the two factors that really get this to run. It's got a lot of room to catch up to gold's run as well. So as you all know, I've been bullish on silver for a while. I think this is the real one. And the last one I'm going to pat myself on the back for is copper. This is one that I was repeatedly bullish on for its breakout. I've been very adamant about why I think this is to be longed. It's the growth in power demand. It's the growth in data centers. It's the, you know, developing markets and frontier markets that are adding to their electrification. There's just so little supply. There's been a lack of exploration. There's a huge deficit. So this one has room to run. Now it's getting a little stretched here. I think it could pull back, but I love what it's done so far. It's broken out of a multi-year range, a lot like silver. I think that it has room over the intermediate term to run significantly higher. So folks, that's everything from this edition of Navigating the Markets. I really appreciate you all tuning in, and I'll catch you around the Discord this week. If you have any questions, let me know on the Discord's questions channel or reply below. I'll catch you next time.